Go ahead and get started. So today, I want to first talk about our final group projects and the requirements, which you're going to be doing your, your presentations, and you'll turn them in on Monday, December 4th, and the presentations will be on December 4th and 6th, and then we'll talk about homework 10. At the end of class, we'll talk about homework 11. So, getting into the home stretch. In terms of the group projects, so basically, what's going to happen is that for the company and the industry that you have been selected, you're going to turn in both a paper and a PowerPoint file, as well as the corresponding associated documents on Monday, December 4th by 10 a.m. The paper should be approximately, let's say, 10 to 12 pages in length. Assume it's about 2 to 3 pages for each section of the project, plus exhibits. So Excel files, the valuation, as is bull, bear, target, RV screenshots, beta screenshots, etc. That's what I mean by exhibits. So that has to be turned in. Same thing with the presentation. So in order to be fair to the teams that are presenting, we have 7 teams. So 4 teams will present on Monday, December 4th. 3 teams will present on Wednesday, December 6th. But all teams will turn their PowerPoints Monday, December 4th. The only thing that will be graded is what is in that PowerPoint presentation and what you say. So therefore, you have to embed all the exhibits into the PowerPoint section and document. And I'll talk about that in just a second, what needs to be there at a minimum. And the main reason I'm going to hold you to this is that if you present on Wednesday, you have a little bit of an advantage because if you see the teams presenting on Monday and you realize, excuse me, you forgot to do something, you could add it later. You can say, oh, here's extra information. So to minimize that, if it's not in your PowerPoint that you turned in on Monday, I'm not going to let you get it for a grade even if you talk about it. So everything is going to be talked about based on what is submitted on Monday, just to be very clear. Also, attendance is mandatory for everybody both days, regardless of whether you're presenting. Okay, so we're going to have a full house both days. And if you don't show up, you lose 5% of your semester grade for each one of the days that you're not here. Also, for 2 of those days of the semester, not the rest of the semester, business casual or better attire is required. If you don't wear business casual, I will send you home and you'll lose 5% of your semester grade. So I am going to be a little bit of a prick on those 2 days, just to let you know that you must come much more professionally dressed than the average class, just out of respect to your peers. And during the approximate 75 minutes of class time, no computers, no phones, no Facebook. Just cut yourself off for the rest of the world. Show respect to your nervous teammates and other people that are presenting, and politely listen to them while they're making their group project presentations. So again, I just think that's going to be a requirement. I'm letting you know in advance. It shouldn't really have to be said, but I've had problems with this at the semesters before, so I'm going to say it now, so there's no ambiguity on what's expected of you during these presentations. I saw a hand. Questions? Okay. So with that in mind, the presentations themselves will be approximately 15 minutes long. I'll have an iPad with a countdown timer. When it hits 0, you're done, just out of fairness to all the groups. All right. So in both the paper and the PowerPoint, you're basically presenting the same thing, just 2 different formats. Okay. One is verbal, the other is written, but basically the 4 sections have to be discussed and presented in both. So for section 1, we've already been doing this, but it's EIC. Okay. And so in terms of EIC, at a minimum, you got to talk about the economy. So you're going to have a screenshot of the economy, and particularly probably the ECSU screen that we talked about earlier. You'll probably need to have a screenshot of the betas. Okay, so you can talk about the relative betas to support your data. And then for the industry, you're going to have to talk about the 5 forces. You'll need a 5 forces table, both today and 5 years in the future. And for the company, competitive advantage, to talk about the industry attractiveness, you'll need an RV screenshot with the operating spread and you can talk about spread versus competition for competitive advantage. All right, so no different than what we've done in previous homework assignments, and what will actually be in the next upcoming homework assignment. We're going to repeat this, but nonetheless, that's the EIC section. Okay, so no surprises there. Historical analysis, same thing, no surprises. You're going to basically have the ROIC tree for your company, and you're going to have the CFI, and you're going to explain it. All right, you did it on the midterm exam. Okay, you've done it on a previous assignment. You'll actually have another assignment coming up where you'll repeat this process. But nonetheless, historical analysis of the company, referring to numbers, talking about major trends over the 5 years. The third section will be multiples. We've done multiples twice, including the homework we're going to discuss today. But basically, instead of doing it for 3 companies, you're going to be doing it for 6 companies. Your company plus 5 peers in your industry. Okay? Similar to the process that we have done. Okay? So again, that is the multiples section. And then finally, the valuation. For the valuation, you will do an as is, a bull, a bear, and a final Excel file. You will turn in all 4 Excel files. But what you must discuss in the PowerPoint and the paper are really the 4 assumptions: growth rate, EBITDA margin, tax rate, and G, why you used each one for each of the Excel files and why you're changing them. So that's the context around the numbers that change the various valuations, which then give you a buy, sell, hold recommendation based on your target, and that's going to be the valuation section. The only thing we hadn't talked about, which we'll talk about next week as part of homework 12, is something called the implied multiple analysis, right? And what that basically means is that when you do your final target valuation, in a sense, it's going to create the equivalent of a multiple. Okay, so given a forecasted share price, you have a forecasted PE, right, as an example. And so what you're going to do is you're going to look at that forecasted PE against the actual trading PEs in the real world and say, does this seem reasonable? So for example, if the entire industry PEs are trading between 15 and 20, and your target valuation says that the PE would trade at 30, well, that probably doesn't make sense. So it's just a way of, sometimes you get into these individual assumptions, you convince yourself of your own bias, and you end up with essentially an unreasonable valuation. This is why they don't allow drinks into the room, by the way. Then you end up with an unreasonable valuation, and you don't realize it. So one sanity check that we are going to do is basically use the multiples as a sanity check on our valuations to make sure that they're not too unreasonable. So we'll talk about that next week. But basically, that's going to be the group project. All right. Now, in the past, and I changed this a couple years ago, but I used to make the whole team present. I'm no longer doing that. It is up to you how many people you want to present, right? Because 7 people in 15 minutes, like, that's inefficient. However, whoever presents is responsible for your entire group grade. So if they screw it up, it's going to destroy the grade for you. So it is in your interest to work with that person or people, whoever's presenting, to make sure that they do a good job. Also, Q&A can happen at any time during the presentation, which means I can ask a question. And if I ask a question and you don't know the answer, it's going to hurt your grade. So therefore, even the people in the room can help you with the questions that I ask. And I'll give you an example. I'm going to ask obvious things. So if you're going through the CFI and there's like 14 billion additional goodwill that didn't exist before, I might say, where'd that come from? And if you have no idea, that's going to be really bad for you. Because over the course of the semester, if your company did a major acquisition, like, you should be familiar with who the acquisitions this company has done historically. So that's what I'm saying. Like, if there's obvious data in there that either doesn't make sense or is glaringly different than competitors, probably going to ask you about it, and you got to have an explanation for it. Okay? And saying I don't know is not going to be good for your teams. So, questions about the presentations? Yes.
So like, I know you said like 7 people is like inefficient. How many people do you think would be good?
In the past, 1 to 3, but it's up to your team. I mean, people have done it by section before, but I will tell you that is a little dangerous. And here's the thing. Each section, for grading purposes, will have the same grading weight. And what I've seen happen is that particularly the EIC section can go long. And I've actually seen people spend 10 minutes on EIC. And the problem with that is 5 minutes to get through the rest of the stuff really hurts 75% of your grade because you got to manage your own timing. So that's the only problem when you get multiple people, is that the transitions, and everybody thinks they have to take the same amount of time. It could actually, if one person goes long and you're just not familiar with how long they're going to take, it could run into trouble for your team. Because the worst thing that happens to teams, and I've seen it happen before, is you just don't get to the valuation and you lose a quarter of the grade for the presentation just because you didn't get to the section. And I wouldn't want that to happen to everybody. That's why I'm making it clear a couple weeks in advance what the requirements are. Hopefully you guys are practicing and collaborating as a team on what that final presentation should be. But I would also say going beyond 3 people gets really difficult in the 15 minutes. But it's up to you. It's whatever you want to do as a team. Okay. And again, just to reiterate, for attendance, all the team members must be here, regardless of whether you're presenting on both days. So even if your team isn't presenting on the day, you have to be here anyways, just out of respect to all the other teams. That's just a requirement I have in this class. Okay. Other questions? Pretty straightforward. All right. And the other thing is we'll learn a lot about these industries. I usually find it to be very interesting when you hear all the companies talking about similar industry, start to get some really good insights. So I'm kind of looking forward to these. But regardless, I've got some questions about what the requirements were. Hopefully you've already started working on this as a team by now, just to make sure, if nothing else, the data is available, started to do your research, kind of compiling it. And then finally, there will be a peer review, okay? And the peer review is everybody gets a group grade, but if you haven't been participating with your team and there's an opportunity for a peer review for your team to say it, if your whole team says that you didn't participate, then I'll give you a 0 for the group grade for the semester, which means you won't be able to pass the class. So very important, don't have your team say that we don't know who you are and we're not going to put your name on the paper, right? Because that has happened before. And I don't want to see it happen. I hope it doesn't happen, but I'm making it really clear, like if you're not working with your team by now in this semester, you better start meeting who your team is, right? And that's why Stock Track started early with the teams, like you should all be working on that. But if you're not, and your team says that you're not, it's gonna be really bad for you because this is a group project. It's not an individual project, okay? You got a question?
Yeah, so you some screenshots and like the numbers are constantly changing on Bloomberg, so like with our presentation in the month away, you want us to update them?
Yeah, so my rule is going to be that I want to have evaluation within 1 week of December 4th. And so you can do, and here's the thing, you can say as of this date, right? Because you'll notice even today's homework, like a lot happened to Procter & Gamble stock price between last Wednesday and today. So, things are going to change. Multiples are going to change. But that's the other thing. Do them on the same day because the multiples, the valuation should be in sync. And if you don't do those in the same day, it could cause problems for your valuation. So the real problem where people run into trouble is consistency amongst the sections, right? Because what they'll do is they'll do division of labor and they don't talk to each other and then they slap it together and then they start contradicting each other. And it's kind of funny, but it's not because it's very bad for your grade. But nonetheless, like I hope that doesn't happen as well. So make sure, as I said, I'd even do the valuations now because it won't take you more than 5 or 10 minutes to update in a couple of weeks. But as I said last week, what you really want to do is make sure you don't have any problems and identify problems now. Don't identify problems like the week of Thanksgiving. Then it's going to be too late, right, to change anything or to do anything. And no one's going to be around to help you. So that's the other thing. So just make sure we get all those problems identified as soon as possible. So for example, think about today's homework. Like if you had to figure out Clorox and Colgate's multiples and you were struggling as much as many of you probably did today, like we're not going to be able to help you later in the semester. Like get that stuff out now. So do your dry runs now at a minimum. And that's the other thing. Integrate with the rest of your teammates. I strongly recommend don't integrate the night before. That's what you're going to do anyways. That's what we do as students. I did when I was a student, but I'm just telling you that's when it gets dangerous because either A, you don't talk to each other, you slap it together, or B, what's worse, one of the team members falls through and doesn't cover for the rest of the team and the rest of the team has to scramble. Like that's where I've seen problems in the past. So I'm trying to help saying these things early to mitigate against these problems because I'd like to see everybody set up for success and actually focus on just getting some good content in these presentations. All right, other questions? Okay, so let's talk about today's homework. Homework 10. Where's Excel? All right, so this is data as of this morning. And as I found out from the morning class, depending on when you did it last week, your multiples could change and some of the numbers could change. So let's talk about the enterprise value to EBIT multiples. So as of this morning, excuse me, these were the EV to sales and the EV to EBITs for Procter & Gamble, Colgate, and Clorox. So 3.5, 4.33, 4.94, 15.32, 15.59, 15.26. These were the WACs as of this morning. And from what I heard from previous classes, everybody was within about 0.1% of those, depending on when you did it. These were the expected ROICs. So what we did for expected operating ROIC is if we went to, I'll go to Procter & Gamble, go to RV, go to custom, and on our operating ROIC, which I had put on the multiple template, but you could have just typed in operating ROIC. This was our custom field. This was the number that we got. So about 18% here, 17.7, 44.6, and where's the other one? About 33. Okay, 32.8. So that was the operating ROICs. Now, here's the thing. This is true for ROEs as well. These are growing perpetuities. Like the key value driver formula is a perpetuity. And so the idea is that whatever number we put in for operating ROIC, and this is true for ROE as well as G, is this is forever. So we're looking at something that's representative of the long term, not necessarily representative of just the next 2 years. And so that's just key to anything we do. So at any time you're putting a number into any model, this is just true in the real world, you need to ask yourself, is this representative? So these are the numbers for 16. Do I think that this is what they're going to earn going forward? All right. Now we do know that over time, ROICs tend to regress towards the mean and growth rates tend to slow. This is a mature industry. And what do we think these companies are going to do? Well, we're making kind of an assumption that they're going to stay in this range over time. So that's one of the key things if we use these numbers right here. All right. So I think that they probably will, but nonetheless, if we don't think that they're representative, we have to change them to what we think is representative, which is what we're going to do when we get to the ROE screen. Okay. But nonetheless, at this operating ROIC, then we have to figure out the tax rates. These were the tax rates that we discussed and got in an earlier class. So I found 23.4 in the Procter & Gamble latest conference call. So somewhere around 23 to 24. I saw in Colgate, they talked about, I think 30 to 32 was the range for tax rates. I think I used 31. And for Clorox, again, 31 to 32. So I used 31. All right, again, plus or minus a little bit. Anybody get anything dramatically different for the tax rates?
I got 28.08 for Colgate Palmolive.
28.08?
Yeah.
Where'd you get that one from?
It wasn't in the transcript at first, so I used financial analysis and I looked through the latest quarter they had.
So you used like the historical ones.
Yeah, the latest one.
Okay. So that's, I mean, again, you'll notice that in the range of G's, it is a range. And I'm giving you a little bit of an opportunity to put in a range because what we're looking at is something that's reflective. So two things. One is if we don't have the forward guidance, that sometimes we might have to use the past, and that's what you did. And that, I'm not saying it's unreasonable, so we'll say that's okay. Or if we think that a company's tax rate is going to change over time, as I said, we need something that's representative of the future, even if it's different than the past. So, and 28 versus 31, I don't think it's going to be that much of a difference in the true G's that we're going to get. All right? Anybody else different tax rates? Similar numbers so far? Because if you do these numbers, you get G's of about 1.68, 3.35, and 1.7 based on this data. All right. Now, because, as I said, the EV to EBITs have changed dramatically and some degree the WACC changed a little bit, I'm accepting the ranges below for grades. This is what I'm going to give the TAs. So if you're in the range of 1.6 to 2.15 for P&G, if you're in the range of 2.8 to 3.5 for Clorox, and if you're in the range of 1.4 to 2, or sorry, for Colgate, and 1.4 to 2 for Clorox, then that is acceptable. Is anybody outside of that range? And your solution? If you look down at the bottom, it's right there. So 2.8 to 3.5. G's. And I'll tell you, this is the third class I've talked about this. This is 99% of everybody's in that range. So I would assume that most of you should be in that range as well. I mean, the person that was out of the range had like for one of them was like off by like 1 or 2% from the range. So they clearly had some mistake in their formula. Other people? Questions? Yeah. Well, as I said, you're going to have a slightly different EV to sales and EV to EBIT depending on the day that you did this. Because my understanding is if you did it last Wednesday when the assignment was first posted, like these numbers were in the 16s, for example. I think this was higher. And I think, because you can see it here, like if we look at the graph price, like their stock price went down over the last few days. So essentially, well, actually, let's do, what's the month? Actually, shouldn't have affected too much. One of them changed a little bit, but regardless, even 85 versus 87, you get a slightly different PE, but not too much. Okay. All right. Questions so far? This one was pretty straightforward. Most of you got this. All right. The PEs where I think is you probably had the more of the challenge. So Procter & Gamble, probably pretty straightforward. These were the PEs as of this morning. 19.63, 23.6, and 21.72. Cost of equity 6.8, 7.7, 6.5. So the question is expected ROE. Now Procter & Gamble, again, I kind of eyeballed it, used 21, seemed reasonable to me. That one was relatively straightforward because if you went to EEO, you would have seen here return on equity 19, 20, 23. And they've been pretty consistent over time as well, even if you go back and look historically. So I use 21, but somewhere in the 20 to 22 range, you're probably not going to have much difference in the G's. Yeah.
So you don't always take the average. That's why I was looking.
Well, here's the thing. If you'd taken the average, that would have been fine.
Okay.
But what I'm telling you is when we first started, I said do average. But what I'm telling you today is think about what we're actually trying to do, and we're trying to look at something representative for the future. And that's where it gets a little bit more nuanced because I can't tell you that 21 or 20.6 is going to be that much of a defining factor because in a way we're kind of backing into numbers which are a quadratic equation because there's multiple things that are happening here simultaneously. And so that's why I'm accepting ranges for this part of the exercise, but within reason and within formulas. So what number did you get, just out of curiosity?
It was CL that I was having a difficult time with.
Let's start with Procter & Gamble. We'll hold off CL and see Alex.
I got 20.
That's what I'm saying. If you were in the 20 to 22 range, I think that's a reasonable approximation. And if you're out of that range and you can make a good determination based on your EIC. So for example, if you read the news this morning, everybody's talking about how horrible they're expecting the retail quarter to be in fourth quarter 2017. And that both Macy's and Nordstrom's are now predicting declining sales this fourth quarter. Even Nordstrom's is expecting declines in sales. So what I'm telling you, if we were doing Nordstrom as the company, then I would probably use a lower ROIC and a lower ROE than probably what's even out there right now. Like I wouldn't use the 2017 or 16 operating ROIC for Nordstrom. It's just not representative of their future. I think it's going to be worse. And so therefore, I wouldn't have used that thing that we did for Procter & Gamble. I would have put it lower. And even if I were more pessimistic on retail, I might have thought that some of the analysts might not have fully absorbed that information by today. I would have actually fully lowered that as well. So again, it's representative and somewhat subjective in the conversation. All right. So back to this, that works out to be about a 2.25% G, which again, I'll accept a range between 2.1 and 2.8. Okay, which should be hopefully everybody in that range for grading purposes of a G. Questions about P and G? Yes.
Wait, never mind that about.
Well, we're about to talk about Colgate or Clorox. Were you about to ask about that? So go ahead and ask your question.
I got like really high expected earnings.
For which one? Both of them?
Colgate was
So let's start with Colgate. So Colgate, And that's why I chose, just so you know, I chose these three companies intentionally because I knew that it was messy, right? So here's the point. This class, as you've known since day one, is not a class that uses Harvard Business School case studies. Because even though they're an effective learning tool, what a professor does is they pick the perfect company that represents the perfect, point at the perfect time. Well, that's not real world. Real world is like you got to deal with messy stuff like these companies. And so that's the thing. Like when I did the pharmas, I chose the pharma example for your previous homework because I knew that they were clean. I chose these three companies because I knew that they were dirty, right? And unfortunately, you have to do it both, and you got to make sense of the not make sensible. So I knew you were going to struggle with this. So that's why we got to do it. All right, so back to Colgate. So PE, pretty straightforward. We can get that one. Cost of equity, this was 7.7. That was this morning. So now we got to do ROE and G. So let's go back to Bloomberg, and let's look at, for Colgate, what's going on. Well, first, if we were to go to the FA, not that we would normally do it this way, but if we were to go here and we were to look at historically ratios, we would see that the historical return on equity for this company has been ridiculously high, right? Just if we looked historically. And then it kind of disappears. And if we look at the earnings estimates, we see that return on equity actually goes negative. Negative 1,300%, negative 11,000%, 5,000%, 11,000%. Doesn't make any sense. Well, why? Why did the Colgate go negative crazy? What happened? Because if I look at the net incomes, they look pretty consistent. So how do they have negative equity? Negative return on equity. Anybody look? Anybody look at the balance sheet? Let's look at the balance sheet. So on the balance sheet, what you can see, we scroll down the equity section, is basically what's happening is their total equity is turning negative. And the reason why it turned negative, and barely positive here, is that basically their treasury stock is 19.1 billion and the retained earnings are 19.9 billion. So basically what they've been doing is they've been buying back pretty much all of their profits in the form of share repurchase, right? On top of that, they've been paying dividends, and they have negative 4.1 billion of other equity, which is basically more than the original equity issued. So they basically have negative equity. And clearly, as the treasury stock has been going up, they've been repurchasing shares and paying dividends. Matter of fact, we can see that on the cash flow statement. If you go to the cash flow statement and you scroll down towards the bottom, then you can see dividends paid $1.5 billion, decrease in capital stock $1.3 billion. These are share repurchases, these are dividends. So they've been buying back just as much stock as they've been paying dividends. If we had done a CFI analysis, we would have noticed this. But that's the problem, is they bought back so much stock and paid out so much dividends, they've wiped out their equity on a book value basis. So that's why the return on equity is a meaningless number. But we need one for a perpetuity. So how do we come up with one? And I'll give you my other complaint. This on the balance sheet, negative $4 billion of other equity, if you go back and look. Is something called AOCI, Accumulated Other Comprehensive Income. And actually, if you click on this on Bloomberg, it'll show you right out of the 10K where they got it. So I know there's some accounting majors in this room. What's AOCI? Yeah. But where's it come from? Like, where do you get AOCI? Anybody know? These are basically direct adjustments to equity that the accountants are making, right? And here's my problem with AOCI. So a long time ago, my first accounting classes, when I was taking them at Wharton, like we learned T accounts. And I don't know if you guys learned T accounts accounting, but I hated it. Because what I quickly learned when I got to second semester accounting is you really didn't need the T accounts to know accounting, but they just love T accounts in accounting. So, so I'm a finance person, but that's okay. No, nothing wrong with the accounts. We need them out there. But here's the point: is the one thing I do remember from accounting in those T accounts is that they created balance sheets, which are snapshot statements, and the income statement was the period statement that explained the change in the balance sheet. So it was balance sheet, snapshot, income statement, period, get to the next balance sheet, snapshot. So the income statement told you everything that changed between the two snapshots. And that's the way that the statements always work together. But here's the problem. There's a fourth statement that nobody ever pays attention to. Okay, what is the fourth statement? I don't even remember the name of it. What's it called? You guys are accounting majors out there. What is it called? It's a statement of stockholders' equity or something like that. And that's the point. The accountants realized a few years ago, companies realized a few years ago, nobody pays attention to this fourth statement. So here's the thing. If you're a hitman for the mob and you got to bury the body that you killed, you don't bury it where everybody's looking. You bury it where nobody's looking. So this is what accounting people are now doing. What they're doing is they're making direct adjustments to the equity on the balance sheet that don't hit the income statement. They hit this other fourth statement that nobody is paying attention to. And a lot of those are called AOCI adjustments. And so that's the problem, is no longer does the income statement explain all of the changes that are happening to the equity, that the accountants are basically using this fourth statement that you would then have to go look at to see where the changes in the equity are happening. And that's where this adjusted other comprehensive income comes in. So I have a reorganization, or I have something, I'll call it AOCI, or I'm going to write off the value of something, I'll call it AOCI, and I don't always put it on my income statement. I'll just put it directly as an adjustment to equity, and I'll show it on the fourth statement. So again, I'm not saying that this was malicious per se, but I don't like it because it should have flowed through the income statement, and I don't like when things don't flow through the income statement. But regardless of all that, the problem that we have here is we have a company that has wiped out their equity. Now, here's another thing. This semester, we're focusing on 3 ratios. And we've ignored the price to book, and we've ignored the PEG, which I previously used in other semesters. And if you read the book, or if you look through other parts of the lecture notes that we didn't cover in class, what you would have heard is McKinsey talking about how basically PE ratio is the worst ratio for using as a multiple for comparable purposes. And the main reason is because it's subject to accounting distortion, because it's based on earnings, and earnings are affected by accounting. Price to book, book value of equity, distortable by changes to the book value of equity. Think about the AOIC adjustments. The PEG ratio, the PE ratio, distortable by earnings. So the problem with the PE ratio is it's the easiest one to understand, it's the most widely talked about, but it's actually the most distortable by accounting. So that's why people prefer, the professionals, enterprise value multiples. Because think about this, they stop at EBIT or EBITDA, and they're not subject to the accounting distortions below EBIT, because traditionally EBIT and operating income are generally not going to be adjusted. And then the flip side is, what really changes in PE is capital structure, amount of debt and equity, and that's really what we're dealing with Colgate and Clorox, is the weird capital structure because they've wiped out their equity. And if you think about it realistically, there is no bank that's going to lend to a company where the shareholders have no stake in the business. Like if I'm a banker, I'm just not going to let you get all the profits with no financial risk at all and lend all the financial risk to the business. So realistically, as a bank, I'm not going to just keep giving you debt to pay out dividends and you wiped out all your equity. No bank is going to do that in their right mind. So realistically, a company can't get rid of all their equity forever. So remember that, just intuitively. You're going to have some skin in the game. Otherwise, I'm taking too much risk as a banker, because at that point, I should own the company. Because if I'm a bank and I do 100% of your financing and you have no financing of the equity holder, like, why shouldn't I just be the equity holder? So I'm just telling you, at some point, you can't go negative equity forever, because the bank will stop lending you money, because otherwise they're just going to buy the company, right? Does that make sense? Just intuitively, if you guys think about this. So let's go back to, how then do we come up with a realistic return on equity for this company? What numbers did you guys come up with, and how'd you come up with one? Tell me what you did, then I'll tell you what I did to get 75%. What'd you do?
I averaged the four numbers.
So you got some crazy high
I got
number.
like 1 point something.
Okay. Anybody else do it a different way? Yep.
Industry average.
I'm sorry?
The industry average.
Okay, that could have been a reasonable point. I could have used industry average or historical average. Let's do this. Multiples are also known as comparables or comparables or comps. So for Colgate-Palmolive, let's look at it this way. What's their PE? Look at the chart right now. What's their PE? Is there anybody close? Clorox? Anybody else close? Church and Dwight? So what we could do is, if they had other PEs that were close, or here's another one, this company is close, or to some degree you can even argue industry average, and we knew that the PEs were close, and we knew that the growth rates were similar, we could look at the ROEs of those individual companies to get a proxy, right? Or let's say it a different way. What's the growth rate of Colgate-Palmolive? Is there anybody similar in growth rate to Colgate-Palmolive? Who's closest to the 7.5 besides the industry average? P&G, 7.3. Not too different. So here's the point. Procter & Gamble has a PE of 20, and Colgate has a PE of 24. They have similar growths. This is a little bit higher. And we know that the cost of equities are not too different between Procter & Gamble and Colgate, although a little bit lower here. We can do the math to see if that explains it. But what's the other factor? Return on equity. We can assume that the return on equity is probably a little bit higher than P&G. So we could have done this a couple of different ways. We could have kind of backed into Procter & Gamble's return on equity and upped it a little bit for about a similar G. We could have put in a G there. Or we could have put in a higher return on equity and solved for a G, which we know was probably a little bit higher than Procter & Gamble's. And then the other thing is, we've already kind of done this in the enterprise value multiples, so we do know that Colgate's going to have a higher growth than Procter & Gamble and probably a higher ROIC, so this is probably going to carry over into the other two. And this is the triangulation effect. Okay, and so this one's inexact as a science, but nonetheless, it says it's going to be higher. So let me give you something a little bit more exacting, which is when we derived the key value driver formula earlier in the semester, this was key. Sustainable growth equals ROIC times reinvestment rate. But this applies to growth in EPS is the ROE times reinvestment rate in earnings. Okay, so here's the point. What's the payout rate of this company? Well, it's 90%. And what's the G of this company? Well, it's 7.5%. Why do we know it's 7.5%? 753. Now that's 5 years versus perpetuity, but we know the growth rate is about 7.53% for the next 5 years. That's the long-term growth rate in EPS. How did I get a payout rate of 90%? Well, if I went back to FA, and I looked at the cash flows, I can see that between the dividends paid and the repurchases of equity, that this was between 80 and over 100% historically. So they had been paying out the equity, either buying back stock or dividend payments of, and you can see it here, that's about 2.4 billion out of 2.4 billion, close to 100%. That's about 2.6 billion out of 1.4 billion, that's above 100%. So that's what I'm saying is the reason why their equity is dwindling is they're buying back more than 100% or paying it out. But I'm telling you, no company is going to be allowed to do that forever because the banks are just not going to let them do it. And if they have any growth, they're going to probably have to invest in something, right? So that's the other side of it. If they're not growing, then they're probably not investing, which is why they're paying out 100%, which also suggests that their G is not going to be too high. All right, so we kind of intuitively know that the G is probably going to be lower, and we have a G from the other one. So here's the point. I'm saying that I don't think anybody can actually pay out 100% forever, so they're going to have to invest something back into the business. I use 10%. You could have used 20%. 10 to 20% reinvestment, you're not going to get much of a difference in the answer. And so here's the point. If I have 90% payout, I have 10% reinvestment, 7.5 divided by 0.1, 75%. If I did 7.5 divided by 0.2, 0.75 divided by 0.2 equals, then I'd be at 37.5%. Okay? So I'm either 75% or I'm 37.5%. So between 37.5 and 40, depending on my payout rate, I happen to choose 75. Now here's the thing. I backed into a 3.7% G. But watch what happens. If this is 40, it's not all that different. Like this number is going to be like 3.8, 3.9. Okay? And so intuitively, I want you to start to understand how the math works. But intuitively, when you see a company that has a high ROIC or an extraordinarily high ROE, unless they grow it, the multiple is not going to change. All right? So here's the thing, is when you get a high ROE, then when this goes to 5 and then 6, then the PE really starts to explode. So that's the other side of it. They don't have a PE dramatically higher than the rest of the industry, so therefore they can't have a high growth rate and a high return. Otherwise, they'd have to have a high multiple. That's what the math tells us. All right? So what it really says is when we kind of triangulate around the theory that they can't have too high a G, but they probably do have a high ROE. And whether you use 40% or 90%, whatever these numbers were before, there we go. Whether you used 40% or 90% or 120%, you're not going to be that far off in the G. All right, because really it just says that the growth is higher. How much higher we can kind of argue about, but that's why I'm giving you a range that says probably, and I'm giving a broad range, 2.5 to 4, right? But nonetheless, that's the range that's going to be acceptable. Questions about this? Can you repeat what we just did? Do you have any questions about what we just did? Yes?
Okay, when you got payout, you said we're not doing 100% because you're estimating that.
I'm saying, so let's go back and let's break down what I said. So right now, their payout of earnings, so we're using earnings here as opposed to ROIC. So ROIC is based on no plat. ROE is based on net income. Okay? They're paying out more than 100% of their net income through dividend and share buyback. They're just giving back more than they're making. And what I'm telling you is long term, that can't continue. Right? Because at some point in time, if they're paying out more than they make, and here's the other assumption that usually goes in the line, they're going to have to reinvest their depreciation or the building's going to crumble around them. They're not going to be able to make products. So let's assume they reinvest their depreciation. Long term, you can't pay out more than 100% forever because anything more than 100% is going to have to come from the bondholders or the banks. The debt is going to have to give you the extra payout. And so what I'm telling you is long term, Nobody's going to pay out more than 100% long term. So, and if you pay out 100%, you can't grow. That's the whole point of the G. G is 0 with a 100% payout rate. Okay? So therefore, because you have 0 reinvestment, and 0 times any return is 0. So we have to have some level of reinvestment. And so what I'm giving them credit for is, okay, they're very profitable what they do, and they're going to make money. They're not really growing, so they're just going to throw a little bit to keep the business running, a little bit to grow. Industry's growing a couple percent. They're going to grow a couple percent, but they're not going to grow 5-10%. So they need some level of reinvestment. I settled on 10%. You could have settled on 20%. I don't think it's going to be 50%.
So the scenario wasn't that they're already paying out 100%. How would you find it for a normal company? Is it
Look at peers. Well, first you talk to the company. If we actually had access as analysts, we would actually talk to the company and say, what is your long-term target payout ratio? Now, here's the thing. We actually see what the company has told the analysts, because if we go to EEO, this is dividends per share. This is dividends. So in 2018, for example, $1.68 in dividends against $3.089 in earnings. So you're looking at 60-ish%. So we already know they're consistently paying 60% in dividends. And so the question is, how much more stock buyback are they going to do? And I'm giving them credit for 30%. Now, what we could have done is we could have said, okay, no more stock buybacks, and it's just this dividend payout ratio of whatever this is, whatever 1.68 divided by 3.089, so 309. So what's that? Equals 1.68 divided by 3.09. So basically 54%. But they're not doing that historically. Like, they're not putting half of their profits back into the business, and I don't see them doing that anytime soon. So I think they're going to keep buying back their stock. And so back to, I know it can't be above 100% forever, just in theory. I know it can't be 0. I don't think it's going to be higher or as low as 54, because what you'll start to get a feel is, as you go through different companies, is, do you remember who invested like half of their profits? That was companies when we looked at Costco. Costco is still growing at high single digits, right? These companies aren't growing at high single digits. So they're probably affording to not reinvest as much because they're not really trying to grow. And so that's the other reason, if you think about it just intuitively, if they were really trying to grow, they wouldn't be paying out all of their profits. So in a way, they're telling you that their growth rate's going to be low. So we wouldn't expect a high G anyways, right? So again, high return, low payout, I'm using 0.1. You could have easily used 0.2 and it would have gotten a slightly lower G, but nonetheless, you could have done it that way. Yes? No? Still confused? Need more practice? Okay, same thing for Clorox. What I did here, in case you're wondering, in the RV screen. Assuming 634, I called that at again 90% reinvestment, or sorry, 90% payout, 10% reinvestment. I rounded off and I said 65%. But you'll notice whether this was 40 or 65, the multiple doesn't change and the G is going to be relatively similar. So you're still going to get a G somewhere around 2. Anywhere in that range. Questions? So for purposes of grading, this is what I'm giving the TAs. That's the acceptable range. I'm being generous for purposes of the assignment. And what we're doing is not easy because unlike what we've done before, there's no pure math solution here. Like, we're kind of triangulating, we're making some educated guesses, and we're making some assumptions. That is why when I grade you on your final paper, group project, and final PowerPoint presentation, because that one I'm grading you on, not the TAs. When I grade you on those, what I'm going to be looking for is what? You tell me, what am I going to be looking for? How am I going to grade you? I'll give you a hint. I'm not going to grade you on your numbers. What am I going to grade you on?
Reasonable estimates.
Exactly. Reasonable estimates. I'm going to grade you on your assumptions. That's why I always tell you to articulate your assumptions. Because I can't tell you with 100% certainty that I'm going to be right because I'm looking into a future and we could slightly disagree. And even in the real world, the analysts slightly disagree. And so that's the point. You could think 2% growth. I could think 3% growth. And I don't know if I'm right or you're wrong. But if I understand that, okay, I think it's 2% growth and you think it's 3% growth and you think it's 3% growth for these reasons, then at least I know that you've thought through a rational process and then I can see how you can come up with an answer. And if that sounds reasonable to me, I'll give you credit. All right? What I'm not going to give you credit for is if you just throw in random numbers and you can't explain them, or I'm not going to give you credit for if you have crazy assumptions that show you don't know anything about the business or what's going on in the market. Those are the two things that you'll get penalized for. And by the way, this is real world. Is we got to figure this stuff out. Other questions? Okay. All right. So let's talk about homework 11. So for homework 11, 2 left. Basically what you're going to do is we're going to bring back greatest hits, and it's going to be EIC and 5-year historical, all right, on a company. And let's just say hypothetically the company is Kroger. So here's what you're going to do. You're going to go in here and you're going to go to the grocery store chain Kroger, KR, and you're going to basically start working on the EIC. So what do I need to do? Well, for the E, I should probably do an ECSU, talk about where I think the economy's heading. Then I should go to the RV. I need to go to the markets. And then I got to go to the beta. And so I could talk about the economic sensitivity. And then I need to go to the RV screen. And then I need to talk about my operating ROIC versus my WACC for the U.S. grocery store industry. So make sure I switch to country of domicile here. And basically, I'd have the spread in that industry. Okay? And so that's what I'm going to need to do. And then I talk about the 5 forces, and then today and in the future, how it's going to affect the spread, and then whether or not the company has competitive advantage based on the data. I'm not going to put the data up in the screen because that's actually going to be your homework assignment. All right? And that's EIC. And then you're going to do the historical ROIC tree and CFI. Okay, so it's basically the first 2 parts of the project you're going to practice one more time. We're going to do it on Kroger. So how do you do that? Well, I go to FA. I go to custom. I make sure I have my templates for the exportable model for Kroger. Output Excel template. Once I have my data, make sure I get rid of my dashes. So find these, replace these with zeros, replace all. Then I can take any one of my models. So in this case, let's say I took my Merck valuation model, or Costco model. Doesn't matter which of the models we worked on this semester. What I really need to do is the model data tab. I need to take the Kroger data, copy, put it into the Merck model, paste special values. And then the last thing I just need to check is my years. The final reported year is 2017. Make sure I have the right year. And I don't have to do anything else because I'm not doing evaluation. I'm only doing historical analysis. So based on putting in the historical data, I now have the historical CFI. And based on the historical data, I now have the historical ROIC tree already filled out. So that's the point. You don't have to finish the valuation of Kroger. You want to, have fun. You don't have to. For doing this exercise, you have to do what I just said. That is homework 11. That is due Monday, 10 a.m., and we'll talk about it. Okay? Yes?
Can need a write-up as well explained.
500 words minimum, covers everything. Covers all EIC and the others. Okay. But as I said, I want to go back and I want to practice it one more time in a different industry, talking about what's going on in the grocery store industry. Hey, Amazon just showed up and disrupted all these companies. Let's see what the impact is, and what your forecast is on a go-forward basis. Homework 12, just so you know, which will be due a week from Monday, our final homework assignment will basically be one more valuation, as is Bull Bear. Okay? Whether we do it with a grocery store or another industry, I haven't decided yet, but that's going to be it. And that's it. Then the group projects. We're otherwise done with theory. As I said, we're just doing application. And that's it for the next couple weeks. And then group projects, and then we're done. Questions about any of this? Okay. See everybody on Monday. Have a good day.